Interest rates did not crash in 2025. They reset the rule of real estate. If you're a small investor buying rentals or a large investor underwriting hundreds of units, the way financing worked in 21 is now gone. What replaced it is a slower, more disciplined capital environment. Today, I want to walk through what actually happened with interest rates in 2025, how that translated into real mortgage and investor financing, and what matters most heading into 2026. Let's get into section 1, what the Fed did in 2025. Let's start with the Federal Reserve, because that's where most of the confusion comes from. At the beginning of 2025, the federal funds target rate sat in around 2.25% to 2.5% rate, the highest level in more than 20 years. Through most of the year, the Fed held rates steady. Inflation cooled but did not fall fast enough to justify aggressive cuts. Late in the year, the Fed made modest reductions as inflation stabilized. By the end of 25, the federal funds landed closer to 4.75% to 5% range. That sounds like relief, but it did not translate directly into cheaper real estate financing. So let's get into section 2. Why mortgage rates did not follow the Fed. Mortgage rates do not move in a lockstep with the Fed. In 2025, the owner-occupied home buyers generally saw 30-year fixed mortgage rates between 6.5% and 7.25% for most of the year. Rates dipped briefly at moments of optimism, then moved back up as bond markets repriced the risk. For investors, the story was different. Rental property and DSCR loans were commonly priced between 7.25% and 8.75%. Bridge construction and value-add debt often landed between 8.5% to 10% or higher depending on the leverage and risk. Really, the key takeaway is this. Lenders price risk, liquidity, and exit conditions, not just the Fed rate. Now, let's get into section 3. What changed for investors in 2025? This is where, in 2025, we quietly reset the rules. Down payments and loan to value. Before 2022, many rental properties could be financed at 75 to 80% loan to value, with 20 to 25% down. By the end of 25, most lenders required 25 to 35% down. Typical loan to value ratios tightened into the 65 to 75% range. Construction and build-to-rent projects often required even more equity. The debt service coverage ratios, lenders became more focused on cash flow. Many required minimum DSCR levels of 1.20 to 1.30 even on stabilized assets. Pro forma rent growth assumptions were stress tested harder, and deals that briefly penciled no longer qualified to institutional capital. Large investors saw fewer aggressive leverage structures and higher equity return hurdles. Hold periods lengthened, and underwriting assumed slower exits and fewer refinancing opportunities. Capital was available, cheap capital was not. Let's talk about section 4 here. What 2025 taught investors? 2025 forced the market to relearn some fundamentals. Rate cuts do not automatically create good deals. Financing structure matters more than the optimism. Cash flow matters more than the appreciation stories. And markets with real demand outperformed financial engineering. Small investors felt this in a tighter cash flow. Large investors felt it in a slower deal velocity and more selective acquisitions. Let's get into section 5. What to watch here in 2026. Now, looking ahead, here's what actually matters. The Fed may continue to cut rates, but slowly and cautiously, especially when we have a new change coming. Mortgage rates may ease modestly, but lending standards are unlikely to loosen quickly. Expect loan-to-value ratios and down payment requirements to remain conservative. Projects that rely on future rate relief to work are risky. Deals that work at today's rates are the ones that survive. 2026 is not shaping up to be a refinance-driven market. It is an underwriting-driven market. Now, in closing, 2025 was not the year interest rates collapsed. It was the year expectations reset. Investors who adapted stayed in the game. Investors who underwrote honestly and are positioned to win in 2026. If you want a deeper insight into how financing rates and build-to-rent multifamily real estate investment strategies work in today's market, I want you to subscribe to this channel and grab my free case study at corybonner.com/case study on how to run a successful build-to-rent project from the ground up.